Hello, my name is Andrew Romans, and I'm the co-founder and general partner of Rubicon Venture Capital, which we are rebranding as 7BC Venture Capital. I want to share a little bit of my perspective on the venture capital startup ecosystem and landscape and where we are right in the middle of June of 2021, and a bit of where I see our venture firm fitting into that landscape. So right now, I think most adults in the United States that want to be vaccinated have been double dosed vaccinated, and things are beginning to return to normal here, while international remains a bit more challenging for travel and getting cross-border business done. And in many cases, we're just doing business over Zoom there. But I think that in the beginning of the pandemic in March and April, there was a lot of uncertainty of how this would play out for our startup portfolio and VC in our VC business. And very much unlike 2008, where VCs were returning LP capital and startups were just going bankrupt and needing to raise longer and longer runways. Most of our portfolio came through this much stronger than they entered it. Most of our companies continued on a 2x to 4x increase of revenue year over year. So that means they made twice as much or 4 times as much revenue in 2020 and into 2021 as they did in the previous 12-month periods. So from net, I think hospitality obviously took a hit and there were some casualties, but overall, COVID has acted as an accelerant to show the world's population what the VC startup agenda was of automating and using technology and doing things online, as opposed to getting in your car and going to Target to buy whatever you were doing. So I think there's a confluence of different circumstances that are driving what is just one of the most active markets I can recall going back to the .com days. And I think it's a mix of actual technology that's maturing, the funding landscape, the exit market, and even an overall more dynamic entrepreneurial funding culture. So on technology, I think that technology, we had the internet came along and that was very easy to spot. We now have software development and AI and ML that are creating kind of Lego blocks that can go after any industry and create automation and efficiencies that are just worth paying for. The amount of money that these companies are saving users, the amount of time they're saving users, the what you can, a computer can read 1,000 documents simultaneously, and what's happening with natural language processing is just such a huge event that I think the number of opportunities are just so great. Each founder is trying to focus on one thing, and another founder can use similar technology to focus on another market. So that in itself is exciting. Culturally, I think that starting a new startup is kind of a first choice for the top graduates of top universities or the most talented people to even be dropping out of universities. So I think culturally, being an entrepreneur is something that people aspire to. You see television shows on Netflix and Amazon that people watch after being at their corporate job or their government job or their banking job. I think that the funding landscape in the United States and increasingly in the US, China, Southeast Asia, Europe, UK, is that you have institutional VCs that focus on pre-seed investing. So you have institutional investors funding pre-revenue companies. The choice of accelerators is just staggering, that startups can get funded way more easily than when I was an entrepreneur in the mid-1990s. Trying to find an angel investor to fund my pre-revenue company was a crazy challenge, where now just a little bit of research and anyone can find their way to getting meetings with investors if their team and their project and what they're working on is worthy of investment. Now, I would say that there's investors to invest before accelerators, during accelerators, at demo days, seed extension, Series A, Series B. And a very interesting thing that's really been changing this year, we're really seeing it in 2021, is hedge funds moving into the venture capital private markets. I think there's maybe 50% as many publicly traded companies on the stock exchange in the United States today as they're compared to 10 years ago. And there's 10x the amount of money institutional hedge funds looking to buy and sell some kind of publicly traded security. So that almost, and then we have the other thing of after the dot-com meltdown, we had Sarbanes-Oxley, stay private forever, that you have companies like Airbnb and Palantir that just in Uber that were privately held long after they ever would have been 10, 15, 20 years ago. And so for those that play in the public markets, like say Tiger Global, they're now just issuing $100 million term sheets across our portfolio and the portfolios of other VCs. So we're seeing levels of funding coming in that typically were not justified before. And so companies in our portfolio are raising money at 750 million pre-money valuations, 450, 350, completing 75 and $100 million rounds, where we invested in these companies at 8 million pre, 7 million pre, 12 million pre, 30 million pre. And we're seeing companies trying to SPAC some of our companies at multi-billion dollar valuations, where up until now, the most liquidity you could get was selling something on the secondary market and a bit of risk and cash management of them. So the exit market, the funding market, the culture, and the technology is really creating a very, very different and robust marketplace. In the past, we didn't really sell anything on the secondary market, but when we see our companies raising at such high valuations, we're creating special purpose vehicles to allow our LPs to buy into this last funding round before the anticipated exit to come in 2022. And we're also returning our fund so our investors get their money back faster without waiting so many years to see their initial investment in our fund back in their pocket. A little bit about how we see ourselves in the marketplace. I generally think with so much competition among VCs, each VC has to prove to the startup and syndicate of existing investors that are driving the board of directors of that company, period, with how demonstrate how are you going to add value. Okay, so your check is good and it's not going to bounce, but what are you going to do to drive revenue or help this company grow in value? What do you bring to the table? And for us, a lot of this points back to the limited partner investors in our fund. So we've taken the time and care to raise money from large corporations that actually want to make not just a financial return, but access startup innovation and bring that internally into their organizations. So if there's a seismic shift in automation, AI, and ML, how are they going to go from taking 90 days to give a loan to a mortgage to a first home or refi or second mortgage and collapse that down to maybe instantaneous with a thumbprint on or facial recognition on their phone? If they're not attacking these sorts of things, they will go bankrupt or at least be Kmart falling victim to Walmart, who's adopting better practices. So the corporate needs to access this information, and the startups benefit from doing business with the large corporation. So we view 7BC Venture Capital as being this middleman that raises money from large corporations and has them active in our events, meeting in person, thanks to vaccines, with our portfolio companies, and spending a shadow week with us, doing an entrepreneur in residence and putting 2 people in our offices in Silicon Valley, New York, and Austin to meet with the startups at the same time that we are. And so they benefit from not just being in a fund, but essentially being an adjunct part of a fund. Then we rotate them back to their corporate and they send us 2 new people. We also have a limited partner associate program where children, family members of family offices from around the world put people in our offices that we treat like full-time employees, and they get an education on venture capital and they get a network to go with it. We can help them get into top MBA programs, or they rotate back to the family office and we have a relationship in place where we know these people really well because they spent 1 or 2 years working with us. And in some ways, we think we've brainwashed them to be double agents that understand us. And again, when we see startups, we can immediately route that to the right person at that family office in whatever country, from Singapore to Indonesia to Brazil. And our startups are getting fast tracked to doing business on a global basis. With that, there's no point of having a network if you don't animate it. David Chow is doing an amazing job with his work at F50, bringing so many people together. And we are beginning in the fall with our in-person event series, where we bring all of our portfolio companies together with all of our limited partner investors that we can manage to come at the same time so they can meet. And we see this as a mechanism for delivering value. So partnering with corporates, partnering with family offices, and partnering with angel investors that are operators, entrepreneurs themselves, who can in some cases even take board meetings on behalf of our fund. So once again, David, thank you for the opportunity. Looking forward to being here with everyone at F50.